Trent Mell, welcome.
Thank you.
Name of your company, what's your symbol, what market are you on?
All right, First Cobalt Corp, based out of Toronto. Our symbol is FCC on the TSX Venture Exchange, and our market is cobalt.
Yeah, there's no denying that. What is the market for cobalt right at the moment? Why would I care about cobalt?
Yeah, we started our company in 2017 on the heels of what I literally call it's an EV revolution, right? We're changing the way we get around.
Yep.
Has massive implications for our economy and particularly for our auto supply chain. And so if you want to back up 20 years ago, cobalt was a bit of a boring metal. We used it in magnets, we used it in hardeners, we used it in, more importantly, jet engines and things of that nature.
Yeah.
Today, half of global production goes into batteries. So initially, phones and laptops, power tools. Today, the biggest application is electric vehicles, and when we're just starting that transition from ICE engines to
and the appetite
EVs.
for it is just going to increase, isn't it?
It is, and it's darn hard to find, which is why we put this company together.
So what is the resource that you're able to tap on here in Canada and the United States?
Yeah, well, it's funny, when we put the company together, we went to the DRC, went to the Congo, because 3/4 of global mine supply is coming out of there.
Right.
We get discouraged pretty quickly, and I've been with big companies, Barrick and Sherritt, and I've been in Mexico and Russia, Australia. So we operated around the world. DRC is in a different level of operational challenges. So yeah, we built up a resource here.
Right.
We've got a big asset base in a town called Cobalt, Northern Ontario, and we've got our flagship asset in Idaho, one of the only places in the world, one of two places in the world where you can actually get a primary cobalt deposit, not a byproduct. And then our third asset, which is really our focus, is our refinery also in Ontario.
Right. Well, let's just talk about some of the challenges out of the DRC and why it makes what you're doing that much more attractive because of the stability that the Canadian and North American markets bring.
Yeah, so China really has a lock on the DRC.
Yeah.
Part of their Belt and Road policy, they've invested a lot of money in infrastructure, and the quid pro quo with that is if we're going to invest all the money in roads and ports and power infrastructure, we want to own the resources, and they've done a fabulous job of it.
Yeah.
And it's a tough jurisdiction for any Western company to operate. There's a way of doing business there in some corners that would get you and I in jail, and not everywhere. But it's the reality you're going to face in emerging jurisdictions. So as a junior miner, you're more likely to face those obstacles than if you're a global conglomerate. And so for us, it just wasn't worthwhile. So you've got call it the corruption angle. You've got a really difficult geopolitical situation. You've got instability. It's a massive country. Poverty, poor infrastructure, and then overlay on top of that, the artisanal labor issue.
Yes.
Artisanal mines are a legitimate way for an emerging economy to allow its citizens to make money and to earn a subsistence living when you don't have a social safety net. But the reality is there's a portion of those that are run with child labor and unfair human rights practices, and scripted labor, and that was an issue typically limited to the northeast of the province where we were mining the gold and the 3 Ts, as we call it. It's found its way into the copper belt where we mine the cobalt, and it's become a really big issue. Amnesty International did a great job shining light onto that, and it's forced us to take a closer look at where we're getting our cobalt.
Well, and rightly so.
Yeah.
You know, if this is our market, if this is where we call home, well, then we want to adhere to those principles that we believe to be fundamentally important in the kind of society that we want to live in. Right. And so the fact that you brought everything home and you're focused here really makes a big difference.
Yeah.
So let's talk. It's the refinery that gives you this unique position that you're in. Tell me about the refinery.
Yeah, so First Cobalt, we came out of the gates really strong in 2017. We put the company together. In part, it was our conscious decision, having looked around the world. Our head of exploration worked in the Congo for First Quantum. Looked around the world, and we recognized there was a lot of untapped potential here. We looked at Australia, we looked at Sweden and Chile, and of course, Africa. Got our hands on some good assets. Our entire team comes out of majors. So First Quantum, Inmet, Falconbridge, Barrick. And so we've seen what can go wrong, right? It's not just the juniors that blow things up. Majors can get it wrong as well.
Yeah.
So it was a very deliberate, thought-out strategy. We merged with 3 other companies.
Yeah.
In the process, we got our hands on this refinery. I'd say we didn't really appreciate how valuable it was at the time, candidly.
Yeah.
We had exploration assets that were giving us a really good market cap. We were the best followed cobalt story on the planet. Through 17.
Yeah.
And we suffered the ups and downs of the commodity, right? We got ahead of ourselves. Cobalt went from 15 to 43, down to 11. And so we saw a big sell off that. But what that forced us to do is to retrench on the drilling.
Yep.
Because the market said, wait a minute, let's slow down a little bit. We're not going to give you more money. And then we focused further down the supply chain. We went downstream to our chemicals business,
Right.
our refinery. Where we are today in the world, we're now chewing our way through a surplus of cobalt hydroxide, cobalt feed that was produced by the artisanals in the DRC. That needs a home, that needs refining.
Yeah.
Almost all of the supply right now in the DRC finds its way to China, and that's why China today controls the cobalt market. That's why it's a critical mineral for Canada and the US, because China dominates that. And so our refinery is a really interesting strategic asset, and it's a very, very near-term solution. Instead of sending all that cobalt to China, we can send it right here to the continent, to the only permitted facility in North America, and have production as early as this year.
So when do you anticipate that you'll be producing?
So our timeline is feasibility studies. We got 2 of them in process right now. One is a quick restart, kind of prove a concept. And then we got a 4.5x expansion that we're planning a year later. And so with those feasibility studies slated for the end of Q1, we would anticipate a joint decision with Glencore in the 30, 60 days thereafter. Get ourselves to a commissioning. I'm targeting November of 2020 right now.
Okay, so that's only 10, 11 months away.
It's not far away.
Yeah.
So plus or minus 45 days.
Yeah.
But I'm off to conversations with Glencore are ongoing. I'm off to see them again next week. And so we'll have better, the closer we get to the feasibility study completion date, the better we'll have a timeline that I can share with you. But right now, there is no reason technically why we can't start that facility this year. And the reason being, all the work we plan to do in the restart is within the 4 walls of the building. Mm-hmm. And you look at what can go wrong with a mining project, permits, we have them. Infrastructure, we have it. Geological model, is what's in the ground actually there.
Right.
We have that covered as well. So the 3 biggest risks that you face when you're building up a mine are not on the table for us right now.
And you have the team as well.
We have a great team. And so we're small.
Yeah.
So we were exploration heavy in the early days. We've retrenched that. We've refocused our efforts. And look, got to keep our G&A low. So I took a salary cut, no bonuses. We're keeping it tight because we're owners as well. Our focus has been on partnering with some of the best. So we've got Asenco Engineering leading the study with us. We got a team behind that, SGS doing the metallurgy, and our own internal work of a team of operators. And so I think things were moving very quietly, very deliberately, but there's we got a little bit of a skip in our jump in our step right now that we didn't have last year, because we're near that finish line. Things seem to be aligning well with the previously published scoping study results, and give me 80 days, and hopefully I'll be skipping a little bit more.
So what's your projected production capacity?
Okay, so this facility ran in the past as a custom facility.
Yeah.
And so it was taking basically material nobody else wanted, running it on a campaign basis. So you might run some complex feedstock for 90 days, and then you set it down, shut it down, bring the next batch in, adjust your met balance and your flow sheet. It was a hard way to run a business.
Yeah.
And typically it was tough extraction, lower recoveries, and you're always tweaking your flow sheet.
Always retooling.
And a plant doesn't like that. I don't care if you're at the milling stage or the refining stage, you want a consistent balance. And so with Glencore, we've got high grade, we got easy to treat, and we've got a consistent feedstock for the next 5 years. So the initial contract with them contemplates about a 5-year term. They provide the feed, they provide the offtake solution, and they'll provide the capital in exchange for all of that. And so the run rate initially at 12 tons, we'd produce about 1,000 tons of cobalt units per year, which translates into about 5,000 tons of cobalt sulfate. And then once we do the expansion to 55, you go from 12 tons to 55, gets you 5,000 tons or 11 million pounds of cobalt. Mm-hmm. Bloomberg New Energy Finance would estimate that's about 5% of the world market. So within 2 years. So you become a real meaningful player, and the only player on the continent, more important.
And you're confident that you have the supply?
Yeah, there's no shortage of supply. We actually, having seized upon this surplus material in the DRC, we tested a generic sample. In fact, it was a lower grade sample than what we're looking at right now, and found it to be perfectly suited to our facility. Ours is a hydrometallurgical facility, which means we take the feed in and we put everything into solution. Yeah. So it leaches really well, and the recovery extraction process has worked exceedingly well compared to some of the tougher feeds historically that we took. And it's not just Glencore. All of the DRC is producing hydroxide, so we've got lots of opportunities, but they turned out to be the best partner we could land on.
Okay, from the investor's perspective right now, what's the opportunity?
Well, we're coming off of tax loss selling season in December, right? We went down to a low of 11 cents, and we've been bouncing around 15, 16 cents, so a good recovery. My cost base is double that, well over double that. In fact, I bought up and down. Yeah. So certainly as a CEO, I'm motivated to see a much stronger price than that. Yes. And the commodity's coming back, right? Yeah. We went again $43 a pound to 11. We're up sitting around 18. The outlook is much more constructive. Last year, I think we had about 2.8% of global vehicle sales were electric or battery or plug-in variants. And that's only going to grow. And increasing.
Yeah.
And so it's a constructive environment. And I think investors, the market has learned to be a little bit more measured with our exuberance. And I'm seeing sort of a steady progression both in our stock price and in the commodity. And when you look at how an investor gains exposure to cobalt, it's hard to do.
Yes.
Most of the cobalt is buried into diversified base metal producers. We're one of the few, and we're the only one, we're the only junior that has the opportunity to achieve cash flow this year. At a modest cost, if I may say, for a mining industry, of $60 million. In fact, this year will be a fraction of that because we're only doing a restart.
Wow.
So the CapEx is right, that might be 10 million. We'll see what the number is for the restart. But it's a small CapEx on a permitted facility that's built with guaranteed feed and the world's biggest cobalt miner. So I'm not going to say there's no execution risk, but we've got a lot of those things checked. And we'll probably have Ausenco help us build it and run it so that as a junior, we don't try to sort of swing for the fences and stumble out of the gate on our first year of production.
Sounds exciting. I wish you all the best of luck. Thanks for coming in and sharing that.
Thank you.
Okay.
Appreciate your time.